Hello there. Thanks for coming. I'm Doug Dillard, and I've met some of you guys before, teaching a class in the business school on hedge funds. And we were lucky today to have a guest speaker in our class who's agreed to stick around and talk to you guys. Tom Purcell, who's a Georgetown grad, 93, and then also a graduate of Harvard Business School. Has been the CIO at Viking up until 2015, and which is, some of you know, is one of the largest hedge funds in the world, and is now running his own firm called Lake Trail in New York. And so he's agreed to join us today, and I'm going to ask him a few questions, and then I'll let you guys ask questions. Just have a kind of an open forum here. So thanks for coming.
Thanks for having me.
I guess maybe we'll just start with kind of your thoughts on the industry today as you've kind of run one of the biggest funds, have left and are kind of doing more of your own thing now. How do you see kind of trends, good and bad, in especially on the long short side in the hedge fund industry?
I think it's a hard industry to define, meaning there's not, so narrowing it down to long short I think makes sense because hedge fund in general is a pretty broad term, and a lot of what we did at Viking, or I'm doing now, is a lot more like what you would do if you work at Fidelity than if you worked at Renaissance or one of the, or even parts of Citadel or whatever. It's undeniable that both the absolute and the excess returns of a number of hedge funds, or a high percentage of hedge funds in the last 20 years has faded down, and a lot of people I think attribute that to size of the funds themselves, number of participants in the market, and I think the two that make the most sense to me, and I think this is an answer that's quite hard, if not impossible, to answer. Or there's three. There's one quantitative, which is that zero interest rates at the short end meant that you didn't get a short rebate. And, we started, really at Viking all the way through 2009 when rates went to zero, you'd make 100 to 200 basis points a year just on the rebate off your shorts. And that's now zero. So that's 1 to 2 percentage points off return. You shouldn't care about that if you're really putting up big results. But that's, I think that's a piece of it. I think another piece of it is that a lot of funds just got very big. We started with $450 million, and grew to be, I think, $33 billion. They just made a decision about 2 months ago to give back $8 billion. But it's, I think once you get over $10 billion, it's a little bit harder to generate returns. Now, that doesn't explain the total number of funds. And I'd say the third thing for sure that's different is just that the availability and transparency of information around the world and the existence of new trading strategies with artificial intelligence or different data sets or other things mean that I think personally it's quite hard to trade on particularly short-term time frames. And we used to do a lot of analyses around what gave rise to what were pretty good returns. And if you broke them out by return on earnings day and then the rest of a quarter, you actually picked up huge, lots of the stock moves happened around earnings day. And the ability to actually, with completely legitimate and legal sources to predict or try to have a better view on how earnings are going to develop or really how people are going to react, I think is just much harder than it used to be. I guess last factor really is just the amount of money going into passive investing, whether it's in ETFs or it's in just broader indices, clearly has an impact. I actually read an interesting strategy the other day, which is there's a manager who's looking for and is really cognizant of single stock weightings within ETFs and then just watching the inflows into ETFs and when they go the other way, because there are a lot of fundamentals sometimes, particularly with mid or small cap stocks, just don't get reflected in prices if it happens to be, if a company happens to be in a sector that's, even if it's a sector that's out of favor and the company's doing pretty well, the stock's unlikely to do well if everyone's selling the ETF. but that can turn the other way.
So do you think the passive thing is here to stay, or do you think it's more cyclical, liquidity-driven? How would you characterize it?
My guess is it's not only here to stay, but I would think it would continue. It seems like, I worked at Tiger before Viking. Tiger was started in 1980, and for a large part of its history, let's say the first 10 years, I think, a lot of the investors were principally just wealthy families. Then it became more of an institutional product, it being hedge funds. When we started Viking in 99, it was somewhat institutional, but not particularly. By the time you got to 2006, you had endowment investment boards, you have sovereign wealth funds, and you had a whole bunch of institutional investors who wanted to be in alternatives or non-correlated assets or whatever you want to say. And then it got to, from the numbers I've read, $3 trillion of assets under management. I'm just reading a lot now of very large investment organizations, whether they're public, state, pension funds or other people who are publicly saying that they want to be in, and they're really focused primarily on basis points of management fees charged and smart beta, and that is a trend that has been happening. But usually, by the time it gets quite
when CalPERS is
spread,
done, it's probably done, right?
Well, yeah, that's possible. I just think it could go on for a few more years, and it's undoubtedly, I don't know. And really, the hedge fund world, in my opinion anyway, aggregate-wise, hasn't put up the gross returns to justify the carries. So, if you don't put up the gross returns and deliver an adequate net return, then you're going to be under pressure anyway.
But you think it's more structural, not just cyclical?
I don't know. I think that I think John Bogle was not incorrect, obviously, and that it's pretty hard to beat the market, and if you want to look at it that way. I think a lot of the smart beta stuff, and I'll probably get completely annihilated by business school professors here because I don't, but
don't worry, there's none of those.
That to me looks like you're just betting on sectors. I have no idea why anybody other than Druckenmiller is going to be particularly good at that, and I don't see why that should be an institutional. And I've had it explained to me in how people run it, and I think that is that's another form of active management that you might feel better about because you're paying 10 basis points, but you better have a good guy picking. And if you have somebody who gives you a strategy that delivers it at 10 bips, then congratulations. But I think some of the ETFs will come under, and smart beta strategies. I think if you have a period of high vol, which I haven't seen in a while, but if you do, there's going to be a lot of pressure. The high yield ETFs are going to come under some serious duress. We've seen a couple short instances of it whenever the taper tantrum was, like May of 13. And, there's been a few instances of it. But you have a very illiquid underlying, a very liquid ETF, and having those two, and if you have a sustained level of outflows, you're going to have a major issue. Larry Fink would vehemently deny that, but he's got a big interest in the game.
So having said that, we just spent 3 hours talking about a stock that you own and liked and think has upside beyond kind of the market. Do you think that's going to be more relevant to kind of smaller mid-cap stocks because of the ETF and passive dynamic going forward, even more so than what we saw back in the 90s and 2000s?
I don't. Well, though the impact that the passive strategies have now for sure is bigger just because they're a bigger piece of the market. And I don't know if you guys read Grant's Interest Rate Observer, but he's been harping on this for a few years. It hasn't yet to really yield anything profitable, to be honest. But I think they have a bigger impact. Where I'm focused now, partially because I'm not running a fund for non-tax paying investors, I'm managing a fund for my family, is really more on longer term time horizon investments for two major reasons. The first one is I live in New York City. Short-term cap gains are not particularly fun to pay, so you want to be long-term for that reason. The second reason is I do think it's much harder to compete at the shorter time horizon. At Viking, I had 25 analysts and a whole big infrastructure, and even for them, I can tell you, because they're all still friends of mine, it's very hard. I don't have 25 people, I got 4. So there's no way I'm going to do that. And I think where I can compete is taking a longer-term view and really just having a view and owning things that I want to own. And size-wise, I own my biggest position, is the biggest bank in Russia, Sberbank, which is already up a lot, and I think it's great. I own Bank of America. That's a very big cap stock. I own this Irish home builder that we talked about today. That's I guess you'd call it mid cap because it's €1 billion, somewhere
Small
between
cap.
Small and mid cap. So I'm not. I don't have an opinion, I guess, but I would think that the ETF impact would be greater at the smaller end just because of the liquidity, differences.
Why don't we open up to you guys? And I've got more questions, but I want to make sure because Tommy has to catch a train in a little bit. So, questions? Over here?
Yeah.
We got a mic coming.
As you move to the Greg Tausig, Georgetown Business School.
Graduate or undergrad?
Graduate. Curious as you've switched towards, or maybe not switched, but currently are focused on longer-term duration investments. How do you think about the type of liquidity that are in these investments? Are you getting more comfortable with less liquid names and kind of more volatility in the intermediate term, knowing that it's your family money and kind of understanding the liquidity profile of their needs? And then obviously a lot more hedge funds have kind of got burned in the crisis with some of their side pockets. Do you see side pockets playing a bigger role as you've seen hedge funds kind of move into the lending space and some other alternative spaces to kind of juice some of the returns?
All right. So in terms of our approach to liquidity at Viking was always pretty dogmatic because I mentioned I worked at Tiger before and that there were like 6 of us when we started out of a 9-person investment staff. The 3 founders also worked there and there were 3 more of us. The last couple of years of the traditional, like the original Tiger, they were way off sides on liquidity. They owned a gigantic position in U.S. Air and some other things, and there were a lot of redemptions. And it's what, like I always think of as the hedge fund death rate. Liabilities are short and the assets are long, and you're not getting, generally, unless you're unbelievably lucky, you're not getting redeemed during a great period when you can unload whatever you want to unload. So we were pretty dogmatic about that. We had, I think the max we ever had, and what I would think of as illiquid, was we were 10% of NAV in 2008-9 in senior bank loans, which, even though they're traded, are pretty illiquid. And then we owned some late-stage tech things like Baba and Facebook privately in 12 and 13. So in terms of my own investing now, I guess I have more tolerance for illiquidity because, first of all, I don't have $30 billion. But in the public stuff, I haven't really gotten that illiquid. But I have more of my net worth. I mean, I had 99% of my net worth invested in Viking. Right now, I've got, I've made some more investments in private companies. The hard thing with private companies, which is also why a lot of pension funds like to have PE funds and private company investments, is what the market is, I have no idea. I'd really rather that the managers, to the extent you're in a fund, didn't try to give you an NAV, which they're required to do because I know it's all made up. Just leave it at cost is how I would do it, but I also understand why the SEC has their point of view. But I don't think I've had to, thus far in the last year and a half, I haven't had a position in an illiquid stock where I've had to kind of hold and not. I own a bunch of a Brazilian railroad, and when I don't know why the president in March was caught on tape with these guys talking about the 2 beef processing brothers, but he was, and the currency in the market went down 25% in a day, and that was, I didn't sell, I ended up buying some more, but my information flow is slower too, so I think you need to really have a lot more conviction. In terms of the side pockets and whether or not it's a bigger trend, I'd say the assets you would like private lending is just a big trend. There has been. I've seen a lot of funds. I know a lot of people who run these funds, and that's because it's been hard to get yield, obviously, in the bond market. I don't know personally if in many instances you are getting paid enough for the illiquidity you're taking as an investor in a private fund, either run by a hedge fund or run by, I don't know what you call GSO or you call, it depends. You have to kind of look product by product. But in general, I think people tend to undervalue liquidity, particularly in periods like now, and for 100 basis points or 200 basis points, it doesn't make sense to me. And if you're a taxable investor, it makes absolutely no sense because you're getting paid ordinary income anyway, and 100 bips,
A lot of the side pocket stuff is more, now they've actually instituted funds.
They've created funds.
They're real funds. They're not side pockets.
The problem with side pockets
separate.
was people thought they were liquid, and then turned out they weren't. Because anyway, in 08, we had a number of redemptions late in 08, even though we were up for the year. And the reason was that a lot of our investors could not get money from other hedge funds that they were involved in because they closed the gates. Yeah. We were quite, and I think the firm will always be this way because they look very closely at liquidity, but we were very intent upon not closing the gates, because I think it's a commitment to your investors if you're running a liquid strategy that if they want their money back, it's their money and they can have it back according to the terms that you've agreed to. I don't know if that answered your question, but.
Well, I was curious just because so many people move into the strategies, whether hedge funds are starting to have to look at places or create new term structures that match different opportunity sets than historical, where most investors wanted liquid everything. And if you don't have this institutional constraint, you move into less liquid publics because there might be some more dislocation there.
There could be. You just have to, if you're whatever hedge fund it is, has to get enough people to sign up for that strategy.
It's a barbell. They're kind of using the passive ETF liquid stuff and then less liquid stuff in other vehicles. Over here.
Thank you for being here. Alvaro de la Isla, second year MBA. With such a long-term horizon and such diverse investments, how do you make the decision to sell?
Well, I've only been doing this like a year and a half. I'd say when have I sold things? I've sold if if the information irrefutably just proves wrong what my thesis is, I sell. That's no different. Or cover, because I still short a reasonable number of stocks. It's a lot less. It's not really balanced. I'm only shorting things that I think are really going to go down. Where I'd say it's, when it's demonstrable to me that I'm just wrong, then I sell. And it doesn't really matter the price.
Or if expectations catch up with you.
Or, if you feel like it's fully valued and you have other things that I have a amount of capital, and if there are other things that I would like to invest in, then, you got to raise capital somewhere. But it's definitely, the long-term long-term viewpoint is really, for sure, driven by just the tax considerations, which managers don't really have because 75% of their investors are either non-tax-paying U.S. institutions or foreigners who don't pay any tax. And so they don't care. And if I thought about it as a company, it's 75% of their shareholders, so it makes sense. And the managers are all paid annually. So it makes sense for both of those parties to not look at after-tax returns. Yeah.
Fed starts to raise short-term interest rates, the tapering of quantitative easing actually putting pressure on the far end of the curve. Do you see equity valuations broadly kind of taking the gradual hikes in stride, or do you see a violent correction if people realize all of a sudden that short-term rates are 1.5%, say, 2 years from now?
Well, short rates are like going to be 1.5 in December, Fed funds. But I think rates are too low, personally. If you go on Bloomberg and you type in Taylor rule, model. It'll autofill, and it'll give you this Taylor rule model. And you can type in the U.S. You can type in any country you want. And the last time I looked at it, the U.S. should be at 4.5 according to the Taylor rule. Now, I'm not saying the Taylor rule is the only way to set rates. And I know the theory of, I don't know any of the people at the Fed, but I know what they've said in speeches and all that stuff. And they really, truly believe in quantitative easing and asset inflation causing, helping lead to recoveries. And then, as Bernanke said in a speech in I think 03, they believe that the 37 recession was caused by the Fed pulling out stimulus too early. And he told Milton Friedman or the Milton Friedman Society, sorry, we learned our lesson, we won't do it again. So they're going to be as slow as possible, and they already have been as slow as possible. But I think rates genuinely are too low. I'm a little bit surprised there's no wage inflation or other things. I do wonder about how the figures are calculated. I think the Fed released an alternative way to look at inflation. The Fed itself did this last week. And there's a bunch of inflation. It's just for lack of a better term, it's rich people inflation. You've got art and houses, and I don't think that's good for the country either. So frankly, I think rates should have been higher already. Rates going up, though, from 1.5 to 2.5 or something, I'd be surprised if there wasn't some sort of setback. But part of the reason I say that is, the Kospi is at close to an all-time high. And, North Korea is about a half an hour north of Seoul. And back when I used to own Cookman Bank, there really wasn't that much going on between the two of them, but there'd be some strange speech, and the whole Kospi would be off 8%. Now you don't even see it move. I don't know how to explain that. Maybe we'll get tax reform. I kind of think we need it, but there's not that many indications we're going to get that here. I mean, valuations are not as cheap as they used to be. It's always hard to say what's absolute high, but it's amazing the amount of things that have been thrown at the market, and you haven't had a break. So I wouldn't be surprised, but I personally think the economy should be. I don't see why 2.5% interest rates should be that big a deal. And right now you have a pretty good global recovery. I don't know how long it's sustainable in Europe. I don't know how long it's sustainable in China either. But so there's been some pretty smart. I mean, Druckenmiller, I think, is on the tape saying he thinks next year is going to be a disaster. For that reason, I'd watch the shape of the curve because it's still quite. If you do a 5-year, if you look at the last 10 years, the 2.10 spread, the 2.5 spread right now is still. They're still far lower than they used to be. Used to be meaning like in 2013 even. And I don't know if the bond market's kind of way behind, but that's a pretty big market to disregard because it generally has predicted things pretty well. We went inverted in 2006, I think, and Greenspan kept talking about the great conundrum. Now we know what the great conundrum was. Wasn't excess savings.
Yeah, hello. Juan González, Spain. I study here English. So I have a question. What do you think will happen with Bitcoins, and would you invest your money in Bitcoins?
I think that Bitcoin, so I don't own any Bitcoin. First heard of it, there's a friend of mine who ran a hedge fund in New York, and he and his partner did really well in 07 and 08, and for about 3 months in 09, and never really turned around and went bullish. So then they got killed in 09 and 10. And one of them was reading about Bitcoin in a newsletter, and they started mining it in 2011. And so I've spoken to him. He owns a bunch of it, and I've spoken to him pretty extensively. My own theory is that Bitcoin is kind of like digital gold. There's a limited number of them. My friend Chad, who has a fair amount, like a lot, of Bitcoin, he said he thinks that 10 to 15% of the world's Bitcoin are already lost because they were mined so long ago, including stuff he was mining. And he's like, nobody knew what they were going to be worth, and people just lost the access code or whatever. So the Bitcoin is on the blockchain, but nobody's going to be able to access it. So I think that there's a legit case, given the amount of fiat money printing, et cetera, that, just like, why is a Monet painting worth what people think it's worth? Because it looks great and there's only one of them, or there's limited supply. So I can understand that. I think the blockchain technology is 100% legit, and for a lot of things, eventually, I don't know how quick it'll happen, but, securities custody, settling trades, keeping title to your house. I mean, why do we have a title insurance industry? It's the stupidest thing. I don't know if you've ever bought a house before, but it's like $1,000 tax for doing nothing. There are lots of things that it could really revolutionize how commerce is done in a variety of industries, and I think that's completely and totally legitimate. Financial services, which I've spent a lot of time in, you're going to have resistance by regulatory authorities and by governments, because governments they're going to want to control what is deemed to be money in their country and legal tender. And they're also going to want to control financial institutions, because when you have a failure of financial institutions broadly, you have civil unrest. And, we didn't really have a ton of civil unrest in '08, but we had a whole lot of angry tempers, as all of us know, and that's continued. So I think blockchain's real. From what I understand, this Ethereum is for sure real, and apparently it's more, it's not, I didn't understand why people were that interested in it, because the supply is not limited, but apparently the computer code, which you may know more about, is far more flexible and will be utilized. I do think, in general, and I've met with, in my capacity as an investor, 2 or 3 people doing ICOs. I think you'd have to be completely and totally insane to put any money, and these guys are raising $50 million in a half an hour. All that money will be lost in a vast majority of these, for sure. One guy I met with explained a $50 million ICO he was doing. I said, well, what are you buying? He said, well, we're going to take the 50, and they're getting a 2% management fee, not paid in their coins, by the way, paid in U.S. dollars, to go out and make investments in the blockchain. And these guys aren't, I checked them with, I'm friendly with a guy named Mike Novogratz who's done quite well in Bitcoin investing. And he's a legit player in the market, and there's an article about him today in the press. But, he vouched for the 2 people I met that they're viewed as being not charlatans, I guess. But when they explained to me what it was, it's a closed-end fund that they can go make investments. The investors have no governance rights. You never have any right to make them. So it could trade at 1% of NAV, and you can't call a board meeting and say, let's liquidate the portfolio. You have no right to anything, except for the guys who run it get 2% a year, and they get 20%. So the only thing I know about that one is between 5 and 8 years from now, the management of it will own the entire trust. That will happen. So Bitcoin for sure is legit. I think there's 8 to 9 million people. And frankly, look, China shut down all the exchanges. The price went from 5,000 to 3,000, but it started the year at 1,000. It's a great mechanism if you're a Chinese citizen and you want to get your money out of that country and not in control of the government. It's also, frankly, the same thing here or anywhere else, which is why, I kind of thought the governments would crack down on it a little bit quicker than they have, but now it's too late, in my opinion. So, anyway, I'm not an expert, but those are my thoughts on it. I don't know if it's a buy or sell at 3,000.
Here first, and we'll come to you.
It's higher than gold, though, which I think is interesting.
Yeah, hi, Abhineet Kumar, MBA first year here. So what's your take on the emerging market, specifically India, the Indian stock market, but also the private market as such, as an investor and as somebody who's observed the market?
First time I went to India as an investor was 2005. Only been there 3 times. Don't consider myself an expert there. He's actually been there as an investor a lot more than I have. My take right now, though, is number one, there was a great deal of excitement when Modi came in. Then things faded, and like they always do, I think he did start to deliver. That monetization scheme he pulled off last year, I have to say, was the biggest bet that any prime minister maybe ever has tried to pull. Exchanging in a cash economy 90% of the most used notes and not having a revolution. I have to give him credit for that. It doesn't seem like he stamped out the black money as well as he had hoped to, from what I gather. The market's ripped since December, and I own one stock there on Dewan Housing Finance Co., but everything is ripped. So I don't like short term. Has it gone too far? I'm not really sure. I think India as an economy, I've always found it quite interesting. I mean, like in a really bullish way, because
It's good companies.
If you take China and India, this is totally simplistic on my part, but here's how I look at them. If you go to China, everything's pretty clean. They've got, Ronnie Chan, who runs Hang Lung Properties, told me you get instant park there. Meaning, like, if you're building a big housing thing, they just put up a park. Now, this is somewhat harder now because there's a lot more development. But, you got a really clean government political system, i.e. there's one party. There's about to be a dictator. He's going to tell you that in about a month. And, and you have big companies, and everything seems a lot easier. The only place there, though, that you really have, and if you go to India, what do you have in India? You have 1 billion people in a democracy. It's absolute mayhem half the time. And they're very short on capital. But the fact that all the companies there have been short on capital for so long and have had to get around this crazy bureaucracy, whereas you have a surplus of capital, I've always thought that the outside of the internet-focused companies in China, which are quite vibrant, mostly because the SOEs are nowhere to be found and wouldn't know how to get in there, the Indian companies that you meet are just, they're way more dynamic. And that's why you have, in pharma and in consulting and in financial services and in a bunch of stuff, there's just a great deal of dynamism. And I also think, you go 20 more years of development in both places, when people have more disposable income and other things, they generally like to have some redress to a court system and be able to vote. And I don't know when, but at some point, the Chinese party is going to have to deal with that, because they've been 20 or 30 years. I mean, this sounds like I'm some political professor, but you've been 20 or 30 years, and the more money people have, eventually, at some point, they're going to want to vote, and they're also going to want a court system where it's not, So, I don't know. That's kind of how I look at it. I think it's a pretty interesting place. We've made some reasonably good money, and it's definitely the one market, I think, where not the one, but it is a market where you really just have to only buy the best management teams, which always makes the stocks look expensive. But HDFC Limited's gone from 30 rupees to 1,800. It's run by an HDFC Bank, I think is one of the best banks in the world. Hindustan Unilever. I mean, there's, any of the consulting firms over time have been good. There's a lot of good companies. And then within a sector, you'll find you could try to do value investing. I don't think it works there because the corporate governance and all that is so bad at the ones that look cheap. They're not cheap. They're just stealing your money. Anyway.
India's very bottoms up. China's very top down. Like I used to describe it as you go to India and there's bamboo infrastructure on new commercial construction, and you go to China and there's just cranes everywhere, which to me was a really bullish thing for India because there was it was really just showing you what a constraint on development was, and you put the same thing to capital and everything else. Tommy said it's just there's really good companies there, but valuations are a little stretched.
Yeah, and it's a battle. I mean, democracy ain't easy. Looking at some of that right now here.
Sorry. Oh, okay. I thought you had a question before. Sorry. Okay, so you do have a question. See, I can read your mind.
Hi there. Ashwin Mathur, first-year undergrad. So given the M&A between...
First-year undergrad, you're a freshman.
Yes.
Where are you living?
Darnell Hall.
Yeah. Too bad.
It's not as bad. It's not as bad as it seems, but anyways. So given the M&A with Amazon and Whole Foods, would you say that will prompt the selling of large cap companies over the long term? Of retail companies.
You mean, is that going to put a bunch of pressure on other grocers and other things?
Yeah.
Yeah, so I think for sure, I mean, the market's been somewhat onto this, but it's going to be Amazon and particularly Amazon, but I mean, it's an incredibly deflationary and disruptive force in business. And it's because they're really good, for sure, and they're almost, maniacal about what they pursue. And the market gives them gives them the capital to go after things at a pretty low cost. So they developed AWS without really making any profits while no one knew what was in there. And I can remember we owned a bunch of Viking, and the analyst prediction was they were going to tell everybody how big AWS was and everything. It'd be a big catalyst for the stock. And I was like, how can everyone not already know this? And you know what? The stock was like 400, and then like 6 months later it was 800. So but my reason for bringing that up is I don't know how many, I mean, that must have been 30 or 40 billion of CapEx that went in and produced no operating profits for quite a long time. So if you're running Kroger's and Amazon just bought Whole Foods, and the first thing they did, now Whole Foods had a problem, which was they staked out that, high-end, healthy part of the market, and they had it to themselves for a long time, and then other people caught up, and they were too high in price. Amazon comes in, cuts the price 40%. What are you going to do if you're Kroger? The Amazon stock price goes up. Everybody loves them. Kroger goes and cuts their price 30%. You know what's going to happen? The stock's going to get halved. So they're in it's tough. But for sure, in retail and there's a great deal of flux. I mean, this will sound insane. Maybe some of you guys have heard of this, but I looked early in the spring. I ran into a friend of mine, actually on a train going from Baltimore to New York, and he said, and I'm laughing because of how crazy it sounded. He said, "I want you to see this private company. It's run by two superstars. There's a bunch of great investors." And, it's going to revolutionize retail. And I was like, all right, well, what is that? And he said, it's in the clothing rental business. And I was like, come on, how many people are going to clothing rent? So the company's called Gwynnie Bee, still private. It's got a big valuation. It's growing very fast. But, and their model is to, and you can look them up, I mean, pretty impressive management team, et cetera, is to rent you clothes. And, the logic actually isn't that crazy. They said in the UK, there's 60 billion pounds of clothes that sit in closets and never get worn. It's a huge expenditure for all consumers that really the utilization of which is quite low. So theoretically, if you could get a bunch of clothes delivered to you that fit you all right and were clean and pressed and all that stuff, probably people would try it. That's their thesis. I thought it was totally insane. They have a bunch of data that shows 80% of women would be interested in because the women demographic is the first one they've gone after. I don't know if it works. I only bring it up because I'm not a venture capitalist.
I think your suit looks great.
I know.
I think it works really well.
Picked this up yesterday, or this morning it got delivered. But Amazon and buying Whole Foods, I mean, there's, in lots of industries the next 10 years, I mean, auto industry, there's just a lot of flux in that, and they are an incredibly destructive and hard to deal with force for the retailers who are out there. I mean, you should look at these private label food companies too.
Mm-hmm. But it helps too. They don't pay tax, right? So it's like there's a double whammy.
They don't pay tax, and they're not required to turn a profit.
Yeah, it's a good combo.
Anyone who owns a stock would say that we're far too cynical for ever mentioning something like that.
Mm-hmm.
To work at a hedge fund. I have no experience being a technical fund manager. Now, every fund manager, despite what I just said, to some degree does pay attention to technical. It's just like, and every technical guy also pays some attention to fundamental things outside of like the big systematic, but even the systematic guys are using lots of data and lots of input, a lot of which is just around valuation or
You mean technical or quant? Those are different. Because technical is literally this chart's breaking out. I'm gonna get out of the stock because the chart's upside down or whatever. Quant is very different. That's using a lot of data sources and data, to predict valuation and other things, and momentum and all this other stuff. There's two different.
You're going to get into quant. You need to have a high-level mathematics degree, for sure, as far as I know, which I don't have. So I have an MBA from Harvard, which I can tell you has nothing to do with mathematics or any numbers at all. So then on fundamental or the types of hedge funds that that at least I've worked at. You just got to apply them and work and try to get a job there. And how do you do that? Well, you got to demonstrate an interest in the market. They're going to come here to interview with them. Use whatever contacts you can to try to get interviews up in New York and just find a way. I mean, there's a lot of resources now that when I was in business school you don't have. So LinkedIn and things of that nature. I'd just be pretty resourceful. The one thing that probably hasn't changed, in however many years is if you're pretty persistent, I mean, people may tell you no like a gazillion times, but, most of the time people who are pretty persistent find some sort of opportunity. And it's some combo of hard work and luck. Like, I just ended up getting a job at Tiger in the summer of '98. If I hadn't, that was how I got into working for a hedge fund. And it was between going to work there at Wellington. Now, Wellington's a very big long-only fund. It's not a long-only fund. It's a big asset manager in Boston that's known as a long-only manager, but they have a huge hedge fund complex underneath it, and all the PMs that I know that work there actually spend a lot more time in their hedge funds than they do on the long stuff. But it's a pretty cool mix for them because all the companies think they're just a big long-only fund, which is a good trick.
But no, you want to do it before you go. I mean, it's 100-hour weeks. It's not glamorous for a long, long time. Yeah. Last question. So you got to get the train.
Thank you for letting me have the last question. And a woman, yes. Well, I'm not a business student.
I'm going to give you the first question.
Sorry.
You raise your hand just to be
clear. I do go to school here at Georgetown. I'm a Master of Science in Foreign Service, second year. And I know that you've referred to several international cases, a lot of trips to foreign countries like India and China, and you've referred to the case in Brazil. So I was just wondering, what do you think is the role of political risk in finance and specifically in investment? And is this a growing role, or do you personally use consultants in political risk?
So
thank you.
Yeah, I'd say it's interesting. When we started Viking, and I was in the Foreign Service School here, undergrad. When we started Viking, we actually, and Tiger had a big business investing in emerging markets. And when we started Viking, we intentionally did not. So we only invested at that point in the U.S., Europe, Japan, Australia. Yeah, I conclude that in Europe. And that was all. And the reason we didn't was because what we found at Tiger was if you were investing in EM, you couldn't totally ignore, obviously, politics and things like that in what we at that point called the Western world. But in EM, it didn't matter if you found the greatest company that you really liked. If you were in Malaysia and Malaysia was having problems, you were in trouble. So you had to call the country right and the macro right about the country and then get the stock right, which at Tiger they had a lot. I mean, Rob Citrone, who runs Discovery, was running EM and so there was a lot of capability. We just didn't have that, so we avoided it at that point. Fast forward, then we started investing in Korea, which we viewed more as a developed market, and then over time we just found good companies and started investing in EMs. And then on top of that, if you really go back to 2008, I ran our financial services practice from 2002 until 2015. I never used to pay attention really to the Fed much, or particularly to regulation or anything else in the United States or in Europe, other than a couple things out of Basel, and not really. Then you had 2008, and the only thing and by the way, you could compare that to someone who did like TMT or healthcare. Healthcare investors had to come to D.C. We'll always have to come to D.C. because you have to see the CMS and all that stuff. Once we had, our housing/debt bubble collapse, you could not ignore what happened here and invest in lots of markets, but particularly financial services. So went from don't invest in EM because there's too much macro and political risk that you have to assess to we kind of went there anyway because they were interesting companies. And on the flip side, you really couldn't say that all these markets we considered developed no longer had political risk or anything else because government regulation and other things certainly came to be. So I think that, I know that there's a very big business in consultancies and just staff at lots of institutional hedge funds out there. In terms of how I'm investing now, or I'd say even whatever, smaller hedge funds are, I'm trying to take a view that's longer, but if you take Brazil right now, I mean, Brazil's been a 5-year saga of, probably starting 5 years ago, the car wash scandal and all this other stuff. And I think someday for that country, hopefully, I think this is actually really good because you've got an independent judiciary, and most of the business people like Oberdech's defense has been, well, everybody's always done it this way. But, that wasn't a great thing for most of the country other than him. And so I think that that's probably good for the country, but getting through that period is obviously going to be pretty hard. And, and it was, but you seem to have a reasonable, right now what you have there as an investor, in my opinion, is you got a pretty good setup from the macro, which is things were pretty washed out. Dilma's out, and she was bad. She just was not good, and from all sorts of economic reasons. Tamara and the people around him seem pretty good. They're trying to push through some reforms that are needed. The country's debt to GDP and deficit is not sustainable, and they're not going to be given the rope that someone like we get. And I don't care if it doesn't matter if it's fair or it's not fair. It's just not going to happen. So I think that stuff's, a reasonable backdrop, and I thought there was a big risk when he got caught on tape in March, but he seems to have gotten through that. And from what I understand from people I know who live there or really invest there a lot, one guy explained it to me this way. He said, the country's going somewhere between center right and right for a period of time at the elections. And the reasons for that is that we don't have anything to redistribute. He's like, we are bust right now. He goes, in 10 years, if we come back again, those guys will come back and they'll want to redistribute. But we're at this period of time where there's nothing to redistribute, and therefore it's really and from a investing stock market standpoint, leaving out everything else societally, that's a good thing. I think for the society there, at least my personal opinion is, and going all the way back to your first question, there is definitely a role. Almost feels like it's bigger. It's kind of hard. In my experience, like how often has using real experts on policy and political economy really paid off? Macro investors all the time because they're trading currencies and all this stuff. We would use them a lot, and I still talk to people because I got a big investment in Russian bank too. And I don't know. I mean, the information's only good for some period of time, meaning accurate, or the politicians or whoever the policymaker can change their mind. And so it's not, I'd say it's like having a consultant around any other issue. But there's a big business. If you're interested in it, it's also pretty interesting stuff, I think. So, anyway.
All right. Thanks, Tommy.
Thanks for asking the
Appreciate
question.
it. Thank you.